Traders often use risk-reward ratio approach to plan which trades to take. A general rule of thumb of risk-reward ratio of 2 to 1, which suggests that a trader is willing to risk $1 with an expectation to make $2 back. However, should you be using 2 to 1 ratio to make your best trade over again and again? Hi, I'm Sibaisa. Today, I'm going to share with you several perspectives on this concept of reward to risk ratio. What is your expectation of trading, and what are the important elements you need to look to thrive in the market over the long run? Click on the subscribe button and turn on the notification bell so you don't miss any informative videos we are producing for you to help you improve your game as a trader. So let's get started. A quick disclaimer that this video is for general educational purposes only, and of course there is no investment advice will be given. When it comes to trading, what is your expectation in trading? And before we go deeply into the risk reward ratio, let us first understand these two important concepts, which is the expectation and reality. The first concept is on expectation. Expectation means what we wish for the market to be. And of course, oftentimes we as traders, we expect the market to go in a certain or particular direction that we want it to be. However, when it comes to reality, it is entirely different from what we expect from the market. So reality is what is actually really happening in the market. Now let's apply this into the actual situation. Now here on the x-axis is the number of trades, while on the y-axis is the profit and loss that we are going to have in trading. And when it comes to expectation, most of us as traders, we expect that the more we trade, our profit is going at straight line upwards. So this is the expectation of, as we trade across time, the more trades that we are going to have, the higher profits that we are going to get from the market. So this is the general expectation of most beginners traders are going to have. However, when it comes to reality, we begin to slowly realize and understand that trading is actually not a straight line upwards. In fact, there would be ups and downs along the way. It is not a straight line. There will be always up and downs. So what it really means is that we can't expect to always profit from every single trade in the market. There will be times we will be losing some money, and there will be times we will be facing drawdowns in our trading account. So as long as we have the necessary trading discipline to follow our trading plan, then as the trade goes by, we are going to be able to accumulate our profit over the long run. Now, speaking on expectations, we can see expectations from different perspectives. We can see expectations from the perspective of mathematics, from the perspective of technical analysis, from the perspective of psychology, from the perspective of logic and other domains area as well. And of course, in this video, we are going to discuss expectations from the perspective of mathematics. So now we will begin to see our trading expectations from the lens of mathematics. And when it comes to mathematical expectations, the most basic concept that we understand on expectations is actually through the reward to risk ratio. And in general rule of thumb, we would have a reward to risk ratio of 2 to 1. And what it really means is that it is a 2 times return compared with the 1 times risk that we are going to take from the market. So for example, is that the 2 times of return is actually the $1,000 of profit that we expect to make from a particular single trade, and the 1 time of risk, which is the $500 when we lose money. So in other words, we can put it in a graphical format where when we enter a particular position, for example, entering a buy position, we expect to make $1,000 when the price goes up, and we expect to limit our losses to $500 when the price goes down. So this is a simple concept of expectation of 2 to 1 in every single trade. So when it comes to risk to reward ratio, we are just referring to a single trade only. However, do you know that what is your expectation in the long run when it comes to a multiple trades? So later we will be looking at these two things, which is the long run and multiple trades. So when it comes to long run expected return, what we want to look at is from this simple formula. So the expected return is equivalent to our profit minus our loss. So this is on the individual trade itself. And when we want to look at the multiple trades, so we can further look into detail on what profit that we have from the trade. So this is where we will be able to see what are our winning trades as well as our losing trades. And if we were to look deeper into it, we can derive another formula, which is the winning probability times how much we make as a profit minus our losing probability times how much we lose in a particular trade. But first, we need to understand several new words first. Now, the first word is on the winning trade. Winning trade means it's a round trip trade that actually makes money. So let's say when you enter and you exit a particular position and you make money from it or make a profit from it, so this would be considered as a winning trade. Even if you make $1 out from it, it is considered as winning trade as well. The opposite is true for losing trade. A losing trade, in fact, is a round trip trade that actually when you lose money. So let's say when you enter and when you exit a particular position and you lose money, so that position would be considered as a losing trade. Next concept that you would need to learn is actually on the winning and losing rate. So let's say on the left hand side, this table where we record our number of trades and what are the results that we get from each trades. So here we have 10 trades in the past, for example, and we will be able to see that we have 4 winning trades and 6 losing trades. So what is our winning probability, or in other words, what is our winning rate? So here we are able to find out that we have 4 winning trades out of 10 trades. So in other words, if we were to put it in terms of percentage, we will be able to find out that our winning trade is actually 40%. For our losing probability, which is our losing rate, is actually we have 6 losing trades out of 10 trades. So mathematically speaking, is that we are actually having the 60% of losing trades. So now that you have already learned several new terminologies on expectations, so let's go into a deeper details on the long run expected return. So before we go into the long run expected return for a series of trades, let's look at what is the expected return for individual trade. So for individual trade, we are looking from the expected return where we just need to look at the profit minus our loss. So let's say we have an expected profit of $2 in a single trade minus $1, and this is where our expected return for individual trade is actually $1. Now let's look at the multiple trades. So for multiple trades is when we have a series of multiple winning trades and as well as a series of multiple losing trades as well. So for example, if we were to have 5 winning trades and 7 losing trades, so from 5 winning trades, our total profit would be $10, and for a series of 7 losing trades, we have a total loss of $7. And ultimately, we will be having $3 of profit across these multiple trades. Now, what about the long run expected return? So for long run expected return, we would want to look at the probability as well as what is our profit. So here we can further derive into our formula where earlier, because we used 2 to 1 reward to risk, right? So we substitute the 2 and 1 into our profit of 2 as well as our loss of 1. So now we want to look further into it of what is the winning probability and what is the losing probability, so that we know that what is the minimum required winning probability for us to make money over the long run. Got it? So now let's simplify this formula to just only one level. So here the 2 is actually the profit that we are going to expect to make from a single trade, and 1 is actually the risk or the loss that we are going to expect to lose from a particular trade. And we want to find out what is the W. And W here is actually on the what is the winning probability that we need to make in order to break even. So a quick simple formula is where you just need to take 1 divided by 2 plus 1, which is your profit plus your loss, and this would be equals to 1 over 3. And in other words, if we were to convert it into a percentage form, it would be equivalent to 33%. Now we would want to substitute this 33% into our winning probability. So here we substitute this 33% into our winning probability times $2 of profit plus the 67% is actually the 100% minus 33%. So 100% minus 33%. So that would be our losing probability of 67% times $1 of loss. So here, the expected return that we will be able to get over the long run is actually equivalent to 0. It means you need a minimum of 33% of winning rate in order for you to break even if you were to use a reward to risk ratio of 2 to 1. So as long as you have more than 33% of winning rate, you will definitely make a positive net return over the long run in your trading. Now, before I reveal to you what is the minimum winning rate for each different types of reward to risk ratio, first, let me share with you there are only 4 ways for you to increase your long run expected return in trading. The first method is when you just only need to increase your winning probability. So in other words, when you increase your frequency of winning, you are able to increase your expected return. The second way is when you increase how much you make with the same winning probability. Once you increase how much you make in a single trade, you will definitely increase your expected return as well. And the third method is to reduce your losing probability, or in other words, reducing the frequency of losing in trading. And lastly is to reduce how much you lose in your trading. So as long as you are able to reduce how much you lose in a particular trade, you will definitely increase your total return in trading. Now, let's look at what is the minimum winning probability that you require in order to break even. So let's say if you have a reward to risk ratio of 1 to 1, you need a winning probability of minimum 50% in order for you to break even. As long as you have more than 50% of winning rate, you are able to make money with a reward to risk ratio of 1 to 1. Now, how about reward to risk ratio of 1.5 to 1? You need a minimum winning probability of 40% in order to break even. How about 2 to 1? We have already gone through this already. You need 33% in order to break even. How about 3 to 1 reward to risk ratio? You need 25% of winning rate in order to break even. And for reward to risk ratio of 4 to 1, you need a minimum of 20% winning rate in order to break even. So in short, you need to have a minimum of this winning probability in order to break even from your multiple of trades. In other words, as long as you have a winning probability that is more than this level, then you will be able to make a profit from the market given your trading strategies over the long run. Now, let's go through a quick and simple example of whether you should be setting your reward to risk ratio of 2 to 1. So let's say on the left, from this chart, we are able to see that there is a breakout from a resistance level. So generally speaking, a breakout or resistance level, we are going to have a long position or entering a long position here. So let's say if you were to use a reward to risk ratio of 2 to 1. So when you enter at this level, you set your risk limit for 100 points and your reward as 200 points. Few days later, when your 200 points has been exceeded, you would tentatively take your profit at this level. And what happens next is that you may be experiencing and you lose out the further movement of over 500 points. So in other words, the market is going to give you 7 times of reward given that 1 times of risk that you're going to take. So whether you should be setting uh, your reward to risk ratio of 2 to 1, well, probably you have your answer already. And back to the very simple basic trading strategy is that we need to always limit your losses and let your profit run. So it is correct that you limit your losses of 1 times risk. However, you should let your profit run as well. Never ever limit your profit to just 2 to 1, because who knows, the market is going to give you more than 2 points, up to 7 points or 8 points, for example. So in short, remember to always limit your losses and let your profit run so that you are able to capture as much profit as possible given the same risk that you take from the market. So let's sum up today's learning on the risk reward ratio concept in trading. So the first thing what you need to do is you need to focus on multiple trades over the long run rather than focusing on an individual single trade. Number two is that you need to make sure your trading strategy has a positive expectancy. So which means you need to have a positive expected return for your particular trading strategy. It's okay to have a low probability of winning rate as long as your net positive return is positive. It's considered very good in trading already. And thirdly, we have already looked into the characteristics of reward to risk ratio. So don't just look at the surface level of the reward and risk or profit and loss alone. We need to look at a series of trades. What is your probability of winning rate as well as what is your probability of your losing rate, and your profit and loss, how much you make when you profit and how much you lose when you are wrong in a single trade. So there you have it, using the reward to risk ratio and focusing on your long run expected return in trading. So hopefully I've provided you some insights on how to set your reward to risk ratio and what is the minimum required winning probability to increase your expected return in trading over the long run. If you find this video informative and useful to you, please share this video and give us a thumbs up. And don't forget to click on the subscribe button and the notification bell. Until next time, this is Steve Iso, wishing you good luck and good trading.